I think the big event of the day is that the Federal Reserve announced that it's very seriously considering raising interest rates by half a percentage point, um, or what they would call 50 basis points at the next opportunity to raise rates. Now we know that the Fed has previously announced that they're targeting somewhere between about 1.5 and 1.75% increase in interest rates over the course of 2022. But their first swing at it was just a quarter point. The fact that they're just a couple of weeks later talking about, a half of a point rate increase, maybe that raises some questions as to how concerned they really are about inflation. I think that initially they were trying to calm the markets down by setting out expectations that, hey, interest rates are definitely going to go up, and hopefully, people understanding that would kind of factor that in and start to behave ahead of time as if interest rates were definitely going to go up. The question is, are the rates going to go up high enough to make a substantial impact on the inflationary rates, which just continue to go higher and higher? So, that brings me back to the fundamentals. And if you've heard this before, then you'll be somewhat familiar with it. But if you haven't, it's worth understanding. There are some macroeconomic factors that contribute to inflation. So, big picture things. One of those is government spending. The higher the spending, the more the government is borrowing, which is effectively like printing money and putting it into the economy. So that is causing inflationary pressure. Another thing is the supply chain. So obviously the war in Ukraine is continuing. There are issues across all kinds of materials and products, including wheat, including precious metals, including oil. So this is impacting the supply that's available to purchase. And obviously, if you've got high demand and low supply, then you're going to see prices up. And then the third big factor is monetary policy with the Federal Reserve. So the last several years, they've been pursuing what's known as an easy money policy. They've been purchasing bonds and therefore injecting cash into the economy. And they've also kept interest rates very low, which allows banks to inject cash into the economy by making loans cheap. So, what we're seeing is that we have no end in sight right now with the supply chain issues. So, those are going to continue indefinitely until something changes. As far as government spending goes, the Biden administration proposed a $5.8 trillion budget for this year. So I think it's safe to say that we can't reasonably expect government spending to go down at a significant level. So really that leaves the Fed as uh, the last effort to get inflation under control, the last area where that might happen. And so for one, when I see that they're looking at being a little more aggressive with the rate increases, that tells me that they're more concerned about inflation than maybe they have been. Because when you take big swings at the interest rates, that's what wakes people up, and employers stop hiring because they know that money's about to get tighter. People who are considering purchasing vehicles or homes, maybe they pull back and they put that on the shelf for a little while because they know that the interest rates are going up. So, that lends to the prospects of a recession. And that's the fear with the Fed raising rates too quickly, is that you might cause a recession. So the fact that they're looking at being more aggressive and risk pushing the economy into a recession tells me that they're very concerned about inflation. So let me kick this over to you because I put an awful lot out there, and let's get your feedback and your thoughts, Psyche.
Yeah, so I was surprised about that. Like you said, they've come out and they said, what, 6 times or so at every meeting they had planned to raise it 1/4%. Um, to to do more than that definitely signals that they're more concerned with inflation, even though the risk of making us or putting us into a recession is greater the faster they move that interest rate up. So what that means to me is they see something we don't see, and they're really trying to slow down just our everyday price. And look, we've talked about this before, where the inflation indexes are coming out at 7, 8, 9%. Well, we know real estate's around 20% year over year inflation, and that could go higher depending where you are. Well, I think they're looking at that, and they're looking at oil, and they're looking at certain food products, and they're saying we have to slow that down. We can't survive. What's the outcome if we have another 20% increase in these categories? And that may be worse than the alternative, right? Maybe we do need to slow this economy down into a halt and somehow fix inflation. Typically, when you raise the rates in the real estate market, prices go down. um, Money's harder to lend out, harder to get for the individual consumer. So it'll be interesting. I can see where they're coming from and wanting to raise it faster, but that definitely signals to me that they're more concerned about inflation than they've previously let on.
The Purposeful Podcast.